Well, as the market closes, let's do a wrap and some stock picks with Martin Crabb from Shaw and Partners. Martin, great to get you on board today, as always on a Tuesday afternoon.
Always a pleasure to come here.
Well, thank you. Let's get a bit of a look at the rate picture first and foremost, because we got the minutes today. The phrase was it was finally balanced between 25 and 50, and as we all know, they went 25. Anything else that we can potentially infer from that, other than they may be just continuing to push us towards this slower rate hiking path, I guess?
Yeah, they spent a lot of time in their minutes trying to explain how they came to 25, and it was obviously a line ball decision, as it was in the previous month. But the ammo that they gave us was they were concerned that they didn't want to go too fast, and that there was a lag between when they put rates up and when consumer spending got knocked around. We can see house prices have already off 10% in Sydney, but the futures market hardly moved on the back of this, so we're still looking at 4% cash rates. So we're going to go up 25% every month except January, because there's no meeting in January, and until May, and then the market's starting to go, well, maybe they go 25, maybe they pause for a couple of months, but we'll eventually get to 4. Fed gets to 5, Bank of England goes who knows where. Coin toss with that one. But yeah, it's interesting because 75% of economists were surprised by the 25 bit move. Most people were looking for 50, and 50 was on the table. The markets wouldn't have minded 50, so it made no sense to go to 25. But it's just obviously they're concerned about, okay, 11 to 12% of household disposable income is going to be going on mortgages, and it's 2 or 3 at the moment. We know that's happening. That's a big bite to the economy on top of the inflationary pressures that everyone's facing as well. So maybe we should just pause now. So give them some credit for at least thinking ahead and not just mindlessly following the Fed. But on the other hand, I don't think the argument's that strong. So, but the market didn't really respond to the minutes that much. What it responded to, obviously, is this Bank of England decision, or according to the FT. The FT is usually pretty good on this stuff. Yeah. That the Bank of England's going to pause QT, and so the E-mini futures for the S&P are up almost 2% again. So it looks like this, oversold market is going to rally again for at least another day or two on the back of this news. So yeah, the sands are shifting pretty quickly, aren't they?
Yeah, absolutely. I mean, I've got 2 questions to ask on that. I mean, first on the RBA, because we saw that futures pricing there back towards around 4%, which is interesting because it seems to be bucking what even the RBA is saying as to where it roughly estimates neutral to be. Also, market economists seem to think that mostly 3.5% seems to be the top end of their estimates. Yeah. Rates market's clearly thinking that the RBA's still got quite some way to go yet. Perhaps that's the first question.
Yeah. And look, historically, economists tend to get it right more often than the markets do. Markets do tend to overshoot, and you've got to price out tail risk as well. So there's a potential for inflation to be much higher than everyone thinks, and therefore, if you're hedging using the futures market to hedge, which a lot of people do, wouldn't you put in a higher number? So there's an element of that. But yeah, most bank economists have got 3.1 to 3.6 as their kind of terminal cash rate, thinking that will do enough to slow the economy and give the RBA some room to pause a little bit. Whereas the market's saying, yeah, they're not going to pause, they're going to keep going until they hit 4, then they'll pause. Yeah. The market, like a couple of months ago, Kyle, was looking at the Reserve Bank cutting rates. Yeah. So they've got the Fed doing that. They've got the Fed going to 5 and then cutting, but they've got the RBA creeping up towards 4 and staying there. So I think that probably does more damage than going fast and then cutting, doesn't it?
Oh, I'm not too sure. Yeah. I guess it sort of speaks to the notion of hard landings versus soft landings. You break something and you try and fix it, or you just sort of, I don't know, slow burn.
Yeah, well, it's a twitchy break, right? So I think it's really tricky to try. Look, I mean, my analogy is like those big iron ore carriers, the ones that get loaded up in Dampier and sent off to China. They take 15 kilometres to stop from when you hit the brakes, right? So that's what the economy's like. But the interest rates themselves are like a twitchy brake. It's like when you buy a new car, you almost invariably go through the windshield the first time you brake, right? Because you don't know how twitchy it is. So they've got a twitchy brake and an iron ore carrier. So yeah, tough job being a central banker.
Yeah, it's much easier just to sort of throw stones from afar and behind a desk, in my personal opinion. And I'm speaking about myself, of course. But just wanted to get another quick comment before we get stock specific on the Bank of England. Is this the market showing central bankers who's boss, and it could be a sign of, I suppose, things to come with other central banks, I suppose the Fed in particular? Yeah,
I mean, I think the government almost took the UK financial markets to the precipice, right? So they didn't realise that having an inflationary, fiscally expansionary budget at a time that the central bank's trying to rein in the economy is a really, really dumb idea. And obviously the market said, well, okay, if these tax cuts get passed and this spending package gets passed 5% of GDP at this point of the cycle, then the Bank of England's going to have to put rates up to some crazy level like 7%, I think they were pricing in. So the gilt market imploded, therefore all the pension funds, the defined pension funds, defined benefit funds, because the UK still got a lot of those. We used to have a lot of those back in the 70s and 80s, but most people cash them in. They've still got a lot of those. They become technically bankrupt. They have to sell their gilts to create this compounding circular effect, and it almost blew up the gilt market. So the Bank of England's basically stepped in to save the gilt market, and part of that will be probably delaying the quantitative tightening, where they're basically going to go and sell a bunch of gilts. They've just gone and bought a bunch of gilts to save the defined pension funds. Then they now go and sell them again. No, so I think it makes sense if the BOE just steps back. But what it shows you is there's cracks appearing in the system. I mean, these are cracks. The volatility, the derivatives that these defined benefit plans are using, the amount of leverage in the system, the lack of liquidity, the fact the central bank's got to step in and save the market. And we're not really done yet on interest rate hikes, so we've still got further to go. So, look, I think it's a positive for market sentiment short term that the Bank of England is being supportive, and that the UK government's done a U-turn on what was obviously a policy misstep, for one of a better term. That's probably being a little bit polite.
Very generous.
So it sounds like we're kind of back to normal now, and we can step back from the precipice. But I still think it's a little bit, the underlying causes, which are higher inflation, higher interest rates, they're not going to go away, and there will be other cracks appearing in the system.
Yeah, I just think it's wild that it's Kwasi Kwarteng, the outgoing or now gone Chancellor of the Exchequer in the UK, a PhD in economic history. There you go. So
didn't use it.
No, obviously didn't read too far back, I suppose. But anyway, we do digress. A couple of stock picks, because obviously the folks at home love that. Hub 24 today, we did see it was one of the big rises on the market. Maybe just take through the results there, and perhaps if you like the stock.
Yeah, so Shaw and Partners got a buy recommendation on Hub 24. It's one of our favourite picks, and across the platform space, we also like Praemium. So there's a couple of those. So if viewers may not understand, but most of the financial planners use investment platforms, and most of that is traditionally owned by the big four banks. But as they've exited the wealth space, they've also kind of downplayed their reliance on the platform. So a lot of advisors that used to work for AMP or CommBank or whatever have gone out on their own, and they've also looked to change their platform and use something that's a bit more flexible and user-friendly. So Netwealth, Hub and Praemium as a group have continued to take market share away from the incumbent players, and who are really not investing in their platform as much. I mean, I know BT, Macquarie, they have some pretty good platforms, but I just don't think they're as nimble as some of the new ones. So they're continuing to gain market share. Now that story's been around for probably a decade, but they've just continued, and these last set of numbers from Hub just show how strong the inflows are. So they're continuing to take share, and the stock is being priced as a growth stock again, because it is getting, I think, got a $3 billion for the quarter. And obviously investment markets are pretty tough at the moment, so people aren't seeing massive amount of inflow. So that $3 billion was a pretty solid number. And people have just looked at the valuation and compared it to some of the other players like Netwealth and saying, these guys look really cheap, so hence the pop today. Look, if you're going to have an upgrade, today's a good day to do it, because momentum is positive anyway. But sort of almost a 15% move higher in that one. But we still like it longer term. We think it's got further to go.
Okay, so like you said there, growth stock. We all love an Aussie growth stock and an Aussie growth story. Next one, would love to get a view on Pilbara Minerals. It's been an interesting space, one, because we know the kind of swings and roundabouts, and maybe that sort of frothiness that has come back into the space more broadly. Just every day it's really, really interesting, because you see the gainers and the losers, and you've almost invariably got two lithium stocks and the gainers up 5%, two lithium stocks and the losers down 5%. A lot of churn in the space. But Pilbara, if there's a blue chip stock in that space, it would be Pilbara, close enough too, for that sector. What do you think about the company and the space more broadly as well? Yeah,
the space is becoming really polarising. We had a consultant from a very well-known international metals and mining consultancy talk about potential bear market in lithium, and the fact that there was quite a lot of froth, because you've got some battery manufacturers really looking to lock in as much supply as they can, and they're using the BMX, the base metals exchange that Pilbara has developed, to get their hands on product. Some players have entered into offtake agreements with players, etc., etc. So there's this scramble to get hold of lithium to make batteries because we all know the supply and demand dynamics don't match. There's not enough lithium for the amount of EVs that people are forecasting. So the market's short, but it is getting a bit squeezy. And so the reason we had a big jump in Pilbara was up to almost $5 on the open was they came out with their latest prices for for the BMX for the auction, and I think they printed $7,800 per dry metric tonne, which was again up a couple of percent on the last one, but it was almost 10% higher than a month ago. So if you've got analysts sitting there looking at their models going, well, I'm not using a price that high, I'm going to have to upgrade. Having said all that, I mean, Pilbara is now a $14 billion company. So for a single product, not quite single mine, but close to single mine, that's a big valuation. So it's obviously predicated on these lithium hydroxide and carbonate prices staying stronger for longer and no supply response coming on. So there are people out there saying, look, there's going to be supply, or at these prices, people are going to start looking at different technologies, maybe accelerate the hydrogen story. So it's starting to polarise people. But I mean, my view as a portfolio manager is these stocks make up, so there's 6 of them in the ASX, including the 2 rare earth / mineral sands players, Iluka and Lynas. And they did make up 3, it's probably closer to 4% of the market now. So if you just market weight in your portfolio, you've got one of these stocks, whether it's Allchem or MinRes or Pilbara. And Pilbara, because it owns its mines and it has that BMX, so it's getting spot pricing, that's probably the cleanest way to play it. I'm not saying it's the best, but it's certainly the cleanest way to play it. So in our portfolio, our model portfolio, we own Pilbara, but I know there's a few brokers out there with sell recommendations who'd prefer others in the space. I think for investors, have an exposure to this theme, whether you want to go and buy Tesla shares or whatever. I think owning a battery raw material player at around about 3 to 4% of your portfolio, that's what the market is. So if you're bullish, you can be more. If you're bearish, you can be less. But just be careful that you are buying something that's already had a massive run. It feels like buying Afterpay at $150 sometimes. So word of caution on, the stocks have already run pretty hard. But I think from a risk management perspective, having some exposure makes a lot of sense.